Times Influence Initiative.
India's investor community is bringing about a financial revolution. This week on NSE Prosperous India, we showcase highlights from the Thane edition, where passionate investors got to understand the potential of India's equity markets.
Context for this kind of a program is that the Indian financial market over the years has been very topsy-turvy while on its journey. Last year saw days when you were extremely happy looking at your portfolios or even the ET Now screen, and there were days which were extremely tragic also. And I can say that about for a large part of this year as well. So that is exactly our aim and objective, to try and remove that perception that stock market is satta, stock market is risky, and try and get all of you to, if not invest, at least be open to the idea of investing. If in the last 20 years we look at how India has prospered, India from being in the 30s rank of one of the most wealthiest nations, we're now in the top 5. We're the 5th largest economy in the world, and I think that is a telling figure. If I were to look forward next 10 or 20 years, what would it take for India to be number 1? I think it's achievable, if you ask me. And it may not even take 20 years, it may take much lesser than that. And while I was driving all the way from Mumbai to Thane, and I was just looking at all the construction and all the development around the malls, the multiplexes, these fancy high-rises all the way. And from the last time that I came to Thane, a lot of the landscape has changed. So point being that you can see India prosper all around you. It's in all of us. We as Indians have prospered in the last 20, 30 odd years, from everything from the shoes that we wear, to the ties that we're wearing, to the phones that we carry, most importantly, which we can't live without nowadays, to just about everything. We did not have these kind of hotels, we did not have these kind of multiplexes. Even in the food that we're eating, the cars that we're driving, the kind of roads that we're driving on, you can see that prosperity all around. Now, how is it that we prosper with India's prosperity? And I think a beautiful way of prospering along with the country is the equity market. I know there is a fallacy that equity market is all satta. We've all seen, movies where there's always a bad guy investing in the stock markets, doing some ghapla or some scam, and in the end, even the heroine leaves him. But that is not what equity markets are about. There are companies like a Maruti, there are companies like an L&T, there are companies like a PVR. Without commenting on the businesses, I think all of us who follow any business news or read any of the pink papers have realized how much they have prospered, and people who've invested in these companies have prospered along with them. So today our initiative is exactly this, that how is it that you can prosper along with India, along with these companies who are shaping India, the new India, and how is it that you can rise with India? So why is it that I should be left behind in this race when India is catching up? We're already the 5th largest economy. Why not me then? And I think equity markets is a beautiful way for us to participate in this growth story.
India is prospering, and there are many ways to prosper yourself from this growth which is happening. But there are also challenges, and there are different kind of instruments every economy will have. There are different styles of investing. There are different ways to interpret the data. All of that is what makes investing a very fascinating subject. As long as you save, I think you are in a very good situation. But once you save, you have to ask yourself, where do you want to invest? Whether you want to invest in equities or fixed deposit or real estate. So historically, because equity markets had a lot of scams, I come from the time when the biggest scam took place in India, the Harshad Mehta scam. A lot of people lost money. And after that, nearly for a generation or, close to 2 generations, people shied away from investing in the stock markets. And the people who really made money were the foreigners who had invested huge amounts of money right from 92. They made tons of money compared to a lot of Indians who shied away from the equity markets and probably put more money in real estate and in gold. Again, historical numbers, if you see, real estate has done well. Gold has done extremely well over the long term. So as Indians, we have been smart. We did invest in asset classes which have done well. But there are some problems in real estate in the sense like it's highly illiquid compared to equities. So if you want liquidity, then you need to ensure that your allocation to real estate is far lower than what it was in the past. Second thing is, we lived in a time in the past when inflation rates used to be very, very high. It used to be sometimes in double digits or very close to double digits. And when inflation is high, it makes sense to put money in real estate. It also makes sense to put in gold. But as inflation rates go down, then maybe the real estate portfolio can be lower and you can continue to invest in equities. By the way, equities also give you very good returns when it comes to beating the inflation. It's probably the best when it comes to, if inflation is around, say, 5, 6, 7%, and if you look at the equity returns over the last 20, 30 years, it's upwards of around 17% per annum. But is 17% guaranteed? No. Because there will be years when the markets will collapse. You go back as recently as 2005, 6, 7, 8. 2005, 6, 7, India did very well. There was this whole concept of BRICS, where every global investor said Brazil, Russia, India, and China will do well. And India was part of that. So part of that madness, because a lot of money came into India in 2005, 6, 7. All kind of stocks moved up. The good ones, the bad ones, the risky ones, the unrisky ones. And then in 2008 is when things changed. When all of a sudden you had this global crisis and the stock markets collapsed. And they collapsed by 60%. So whatever money you make in 2005, 6, 7, you would have probably lost that in 2008. And then again it recovered by 2009, 10. So the thing about equities is the volatility is a given. And I don't think you should ever worry about volatility, because volatility is just a mood swing, right? It's just the prices moving up based on how people feel at that point in time and then how they analyze. But if you really look at the long-term charts, once the volatility, you understand how it happens and you look at the charts, they continue to move up. They will continue to move up because India as a country is growing and we have different companies in different era. So go back in 1980. 1980, we used to have the index which was dominated by textile companies, used to be dominated by banks. And then each 5 years, if you look, things have changed. From textiles, we moved on to other commodities. Then you had the software companies coming by around the 95, 96 period. Then you had the banks getting reduced, media companies coming into play. So different industries prosper as the country continues to grow, and the way of doing business also changes. So right now, if you see also, like, even 10 years back, there was this huge wave towards retail stocks. We said the big box retailing, the large malls will do well. But if you now look at the last few years, it has moved away from big box retailing to internet and mobile, and now most of the shopping is being done on the mobile. You still shop, only the method of shopping has changed. So therefore it will have an impact on certain kind of companies. People who had bet huge amount of money on, say, the retail space and the big box retailing have probably not done so well, because people have very rapidly adopted to the mobile way of shopping. So we didn't yet as a country, we haven't experienced the kind of growth which Walmart had in many other countries, right? But Walmart is a big box retailer and they have done great work in many other countries. But India progressed so rapidly into e-commerce that before Walmart could come, we moved away from big box retailing to the internet model. And that's the reason you have Walmart actually buying into India in the e-commerce space. As you know that they have bought Flipkart, so they are directly experimenting with e-commerce and not putting the big box retailing in India. So business dynamics will change, but as long as you know that there are certain managements who are smart and will take advantage of this opportunity, it makes great sense to be in equity. So some caveats as to on the equity side. The first and the foremost is you need to have a clear idea as to what kind of goals you have, what is the time horizon, how long are you willing to wait patiently for these returns to come. In the case of equities, as you can see, it's a long-term chart, and the equities also will continue to be a very long-term kind of investment opportunity. So if you understand that, then I don't think you will ever be worried about any kind of volatility, and you will continue to invest. And I think in the long run, that prosperity will continue.
Moving ahead, investors got to interact with Ivy Subramaniam of Quantum Asset Management Company to further break down the fundamentals of investing.
People feel a little enamored, intimidated that I don't have proper knowledge. How will I invest in stock markets? How is it that you get over the fear of investing in equities?
Once you research, you become comfortable, and then you go and buy. So it is the same approach. So as a student or anybody who wants to invest in equities, you don't need very detailed knowledge of all aspects, but you need some knowledge. You need to know what you are investing in. And one clear case in equities which makes people nervous is because the prices go up and down. But that is why it is called a market. When you go to a vegetable market, every day you have no clear idea what will tomato be costing tomorrow, right? You go there, the rates change by a rupee. Yesterday it could be 10 rupees, today it could be 11. Because it's a market, and the market is a place where supplies can change, where demand can change, and there could be some disruptions coming in, and that changes the people's emotion when they buy or sell. It is the same concept. You put it in the stock market. It is not a place where you are buying a business. It's a place where you are trying to see whether people are scared, whether people are happy, whether, are they bullish, are they bearish, and then you say, okay, in this kind of market, what should I buy? How should I go about buying it? It is a market. So you can pick your choice, and you can take your time before investing. So once you understand that, then I think the comfort level will very easily go up.
So, I want you to also help our audience understand the mechanics of greed and fear.
Whatever happens to the market, keep an eye on your goals. If your goals are still 5 years, 10 years away, it just doesn't matter that that the markets are hitting new peaks, because there is enough for it to do in the next 5 years. Yes, after it hits a new peak, it will go down, but it doesn't matter. As long as you don't need the cash immediately, you should continue to be invested, because it will continue to grow over the next 5 years, 10 years, etc., etc. 2008 event happened, yes, but did we have something like that in India in the past 38 years? Many times we have had different kind of scares. In India, we have had banks collapse. If you remember, Global Trust Bank was a very large, one of the initial private sector bank which went bust. So we had such situations in the past. Right now, what is happening is we have a lot of news about the globe, right? People read not just about India, you read about the globe. So that information overload sometimes can make you nervous. But did India collapse in the last 38 years? No. But did we face a lot of situations which were tough? Yes. So if you remember that, then you will know it doesn't matter. 2008, yes, people are worried, but it's not the end of the world. We will still continue to grow. If you remember that, then that will first calm you down. Once it calms you down, then you can look at the markets again, and then you feel you have the appetite to invest, you go and invest there. So the first crucial thing is to ensure that your mind is not agitated or excited. And that's the way to take advantage of the market. So if 2008 was a period when you were scared, you got to step back, calm yourself, and then if you look at the markets, you will actually find tons of opportunity, because you still believe the long-term story in India, and therefore you will go ahead and invest.
I think the most important thing before you get into equity markets is also, am I that smart to buy stocks and select stocks and handle my portfolio on my own? If I'm not, just leave it to a mutual fund manager. Invest via the SIP route. Soch kar, samajh kar, invest kar. SIPs, Ivy, is the most safest, most reliable way to go with it.
Sure, I agree to that. It's definitely a very attractive way to invest. The key thing in SIP is really it brings a discipline in you, right? You have a monthly check going from you, an outflow going from you and into the mutual funds. And that discipline is very, very vital. If you don't have that discipline, then most probably you will be whipsawed by all these emotions. You know, you will pull out at the wrong time, you will invest at the wrong time when everybody is excited. And that can have a very, bad effect on your portfolio. But if you have a discipline where you keep investing money every month out of your savings, then you tend to average out. You tend to average out between the excitement and the fear, and that in the long run will continue to generate. So yeah, as a retail investor, if you don't have the tools to study companies, to study balance sheets, to look at managements and what they do, then it makes sense to invest in a mutual fund, which is a very effective way of investing. And within that effective way, if you do an SIP, that is even more effective. As you grow, as your financial goals are met, then you can also look at, systematically withdrawing. You can decide when you want to reduce your investments in equity. So it's a very good, there are a lot of good instruments available for you to get in and get out in the case of mutual fund. And that's what I think retail investors should look at.
Let's take some audience questions. Anyone who has a question for Ivy?
What is your current view and when do you think that the auto sector will be out of its slump?
I think in 2018 or 2019, we sold close to 23 million two-wheelers, out of which 2 million was probably export. So you still have around 20 million two-wheelers being sold. You go back and you stand in 2008, I think 2008 probably it was around 8 to 10 million. So in 2008, it was challenging for many people to think that India will be selling 23 million two-wheelers. But the fact is, from 2008, even in 2008 when the penetration level was very high, each year we have grown. And that 8 or 10 million has now become 23 million motorcycles. That's the beauty of India, that we will continue to consume. But it is cyclical. It is cyclical because people decide when to buy or not from a variety of factors. If there is agriculture distress and the income level in rural India is low, you will find the demand slowing down. In urban India, if there are job losses, then you will find the demand slowing down. But incrementally, the demand will continue to be high. So some years it can be growing at 8-9%, some years it will grow at 6%. So I don't see a slump right now. I think it's just a small slowdown which is happening because there is distress in rural India. But once that gets cleared, you will find the growth coming in. The beauty of the 23 million two-wheelers which we sold, and if you look at the population of the two-wheelers, probably we might be having around 200 million two-wheelers in India right now, right? So 200 million two-wheelers, people tend to change every 5 years or 7 years, depending on which era you were born and grown. Like during my college times, people used to hold a scooter for 15-20 years, right? We had Bajaj Chetak scooters and people held it for long. But now it's not like that. People buy every 5 years, they try to change. Because they find new technology which reduces your running costs, or you find very fascinating products and you are okay with borrowing money and buying that. So out of this 200 million, even if say 5% people change, that itself will drive your demand every year. So you have 5 or 10% can means between 2 million to 4 million motorcycles just coming from replacement demand. And then you have the new people buying it. That is one trend.
It has been fairly fruitful, and I hope we've managed to convert at least some of you who did not raise their hands at the beginning of the session to at least start tapping your feet in the water and beginning to at least nibble in, at least go with an SIP of a small amount, like maybe even 500 rupees per month. But try and see where it goes in the next 5 to 10 years. Just the way that we buy gold or buy a house, we don't track the prices daily, do we? We don't. After 20 years, when we want to sell the house, then we see, oh my God, it's appreciated. I bought it for 1 crore. It's doubled or tripled. So just the same way, treat equity markets also with patience and believe in it. I think that's where it all begins.
Thank you.
Okay, thank you so much.
A Times Influence Initiative.